Okay, moving on. So hope all of you are back. Cash flow based valuation, basically from the entity point of view. It's also popularly called in practical life as DCF model, discounted cash flow model. From the shareholder's point of view, we have done the dividend theories now because for the shareholder, dividend is the cash flow. But if you think from company point of view, entity point of view, what cash flow you get? We can divide this into two parts. One is free cash flow to firm, other is free cash flow to equity. But first of all, let's understand what is this free cash flow means. Basic structure, you have company, you get the money from various kinds of people, that is shareholders, or you get money, loan, debt, like debenture holders, let's say, or lenders, and you invest in various business. You do various projects, and whatever the money you get, you are going to give it to various shareholders and lenders. So what money you get from the business, from the entity point of view, I am only interested in cash flow. I don't want to focus on earnings. I don't want to focus on profits. Financial management people, we are fully focused on cash flow. Now, can I say cash flow is same as profit after tax? It has some restrictions. I'm sorry. It has some restrictions. What is that? Can you tell me why profit after tax is not same as cash flow for the entity? Cash flow from its business will be not same as profit after tax. Many reasons are there. Can you take up one important reason, obvious reason? That is depreciation, non-cash. Because for profit after tax, I would have subtracted depreciation, right? So I'm going to add depreciation. And profit after tax, we would have calculated based on accrual method. That is credit sales, credit purchases, everything would have taken. So if you have to do an adjustment, I have to do an adjustment towards working capital. And what I'm calling you is free cash flow. What is this free cash flow? Free cash flow means without any obligation. So from a business, especially growing business, I have to expand my capacity. I have to purchase machinery, furniture, building. I have to acquire some patents, copyrights. Franchisee fees means the money will go towards acquiring fixed assets. We say Capex. After that, the money will be available to the lenders and shareholders. In the sense, for the shareholders, I may pay dividend if my money is available, or for the lenders, I will repay the loan. I'll pay the interest and so on. Basic structure, hope you got it. Okay, so free cash flow means it's cash available after all commitments. It is after non-cash expense. That is, do not consider non-cash expense like depreciation. So it is calculated by subtracting, adding back depreciation and subtracting things like working capital changes, increase in working capital, and capex expenditure like purchase of fixed assets. You can view from two points of view, from a firm point of view, or you can think from equity shareholders point of view. That is what is difference, FCFF, FCFE. I will tell you the difference, how those two things will have that. Then I'll go for the valuation aspect. Okay. Now, so FCFF, free cash flow, means I told you after all commitment. It's without any non-cash element, after considering capex, capital expenditure, after considering working capital changes. So we can view from two people point of view. Let me write it clearly. from the firm point of view. From the from point of view. From the entity point of view. Remember, I told you about enterprise value from the firm point of view. Let me give an example, then I'll give the formula. Suppose you have a house property. You get rental income of 1 lakh. But you have taken some loan for that house. So you have to pay interest of, let's say, 20,000. So you have net inflow profit of 80,000. Now, can you please tell me in this example, from the house property valuation point of view, from the property point of view, what is the income the property is generating? Should I tell 1 lakh or should I tell 80,000? From the property point of view, from the house point of view, it is 1 lakh. Why? Because you have taken loan, you are paying interest. You transfer it to somebody else. They have not taken loan. They don't pay interest. But house property income will not change, right? From the property point of view, it 1 lakh remains same. But from the owner point of view, it is 80,000. I hope you understand the difference. So for the firm point of view, interest should not be subtracted. We are purely thinking from the business point of view. We are purely thinking from business point of view. We are not making any distinction between debt and equity. Put together, it is capital employed. So from the firm point of view, interest is not an expense. And dividend is also not an expense because they are all considered as payment to capital employed. So interest and the dividends, both not expense, not considered as expense. This is firm point of view. From the point of view of equity shareholders, equity point of view, equity shareholders, equity point of view. For them, interest is an expense because these lenders are outsiders. We are thinking from owner point of view. We are not thinking from shareholder foreign point of view. This is thinking from owner point of view. After all, outsiders payments. So interest is expense, but dividend is not expense. Dividend is not expense. Why? It is like withdrawal, right? It is my money, I'm withdrawing. Income, earnings belongs to shareholders. You withdraw dividend. What belongs to you, take out from that. So what is the cash flow or what is the amount available to you will not change. Earnings will not change. Distributed profits might change. Retained earnings might change. But earnings made, profit made, cash flow made will not change. You decide to withdraw your cash. So dividend is not an expense. It's like your salary comes to your account. You withdraw the salary. That is not an expense, right? It is just a distribution. So dividend is not an expense. Interest is an expense. So FCFF is calculated like this. FCFF. We calculate. We don't start with profit after tax, or I will be doing like this. I will do EBIT into 1 minus T. EBIT, you know, earnings before interest and tax. Don't subtract tax, you do after tax. Or I can do profit after tax plus interest into 1 minus T. So basically, I have subtracted interest earlier, now I add back interest. So this is what is going to be your, I'll say, net operating profit, you can say. Or this is called as net operating profit after tax. No PAT. Net operating profit after tax plus depreciation because it is non-cash expense minus Capex minus capex minus increase in working capital. Capex means fixed assets, property, plant, equipment, purchases. Working capital increase for a growing firm, especially will have more sales, more debtors, so debtors will increase, creditors will increase, cash will increase, inventory will increase, working capital increase in working capital means cash flow reduced. So this is called FCFF. So NOPAT plus depreciation minus capex, basically interest element, I am adding it back. This is FCFF. If I treat from FCFE point of view, free cash flow to equity, FCFE point of view, then I'll start from profit after tax, because interest also I have to subtract, plus depreciation minus capex minus increase in working capital. Or if I take minus common, some people also do that. If I take minus common, how does it look like? Capex will be positive, increase in working capital will be positive, or capex minus depreciation. Some people call it as net capex also. Capex minus depreciation, because I'm taking minus common, plus increase in working capital multiplied by, I don't have space, I'll read it once more. Sorry, this also we should do, but I'll just take it common. This portion I'll multiply it by debt plus equity. Or we will write like this. Formula goes like this. PAT, I take minus common, I get capex minus depreciation plus increase in working capital. This portion what we have after taking minus common, this I'll multiply it by debt plus equity. Debt by debt plus equity. I will tell you the logic behind this calculation. This is to make sure the debt equity ratio is maintained. Sir, what is that? I'll explain you the logic. Suppose you are planning to purchase a capex, fixed assets, furniture worth 1 lakh. You are purchasing 1 lakh. So how much cash flow required? 1 lakh. Suppose you maintain debt equity ratio of 1:1. So if you are purchasing 1 lakh, where the source is entirely is not from equity shareholders, you have to maintain a 1:1 debt equity ratio. So out of 1 lakh, 50,000 comes from equity, balance 50,000 comes from debt. So basically loan. So as far as owner's point of view, how much is your cash outflow? Only 50,000, right? So what I'm doing it here now, 1 lakh I'm taking, cash flow required capex minus the loan I'm taking. 1 lakh minus 50,000, that is only 50,000. Or sorry, not debt by equity, I'm sorry, it is equity by debt plus equity. I'm sorry, this is E by debt plus E. E by D plus E. In the sense, out of 1 lakh, what is equity shareholders' responsibility? That only goes out of pocket from equity shareholders. So if equity ratio, debt equity ratio 1:1, equity holders outflow is 50,000, 1/2. Okay, if the ratio 70:30, 70 debt, 30 equity, only 30% goes from equity shareholders' pocket. Balance 70% you take loan. So 100 rupees outflow, 70 rupees come in, effectively 30 rupees go out. Or can I say, out of 100 rupees, 30% is the outflow responsibility of the equity shareholder. That is why multiplied by equity by debt plus E only apply for second part, does not apply for PAT. PAT is already from the point of view of equity shareholders. And if you have any debt repayment, that also you're going to subtract. So here you subtract if you have any debt repayment. Subtract debt repayments. if any. Okay, so once you have FCFF, once you have FCFE, you can compute the value. What is the value? FCFF, we compute value of firm. I'm using cash flow of firm. So value of firm is given by FCFF 0, that is basic year, into 1 plus G divided by KE, not KE, KO or WACC, because this is firm point of view. So we take overall cost of capital KO minus G. Whereas equity point of view, that is value of equity. Value of equity, that is given by FC FCFE 0, FCFE, where free cash flow to equity, into 1 plus G divided by KE minus G, because cost of equity here we are thinking from equity shareholder point of view. And one more way also you can do, for the value of the firm I subtract debt, I get value of equity. Correct? Value of firm includes both debt as well as equity. So from the value of the firm, I subtract debt, then also I should get value of equity. The amount may not match for mathematical reasons, but practically this method is used a lot. Value of firm minus debt is value of equity. In fact, to be specific, we subtract net debt, debt minus cash, net amount we subtract. Anyway, so this is the overview of cash flow from firm point of view, cash flow from equity point of view. I'll just give a tabular format also in case they give you income statements. I'll just give the quick format for that as well. You write down this part. Let me know if you have any doubt. Okay, I hope you have taken down. Let me just go for the full-fledged problem. And in fact, practically, this is what is going to happen, because I have worked with equity research firms, lot of brokerage firms, I'm aware of it. They are ones who follow this. This is the summarized format. In practically, they will prepare many, many Excel sheets. So full-fledged using income statement. So FCFF or valuation using income statement. So you will have like this. Okay, you will always start with a base year, like a year 0. But year 0 is not for calculation, it's only for arriving some ratios. What ratios? I will tell you. You start with base year. You will have one column, like year 1, estimations. Okay, these are all estimations. Just example I'm giving. Year 1, year 2, year 3, then let's say year 4 onwards. Dot, 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 dot. So you will have income statement like sales minus some operating expenses. Let's say you get EBIT, variable expense, fixed expense, admin expense, everything you subtract, operating expense you subtract. So you get minus interest, or if you don't subtract interest, you get FCFF. I would like to tell FCFF. So minus tax. So what you get is net operating profit after tax. Then you will have plus depreciation minus capex, capital expenditure, minus increase in working capital. Then at this point in time, what you get is FCFF, because I'm not subtracting interest. Have I subtracted interest? What I get is FCFE. Then you see year 4 onwards. What comes to your mind? Year 4 onwards, where the growth rate is getting stabilized. We apply constant dividend growth model. So year 4 onwards means this is FCF F1, FCFF2, FCFF3, but FCFF4 onwards, FCFF4 or FCF3 into 1 plus G by KO minus G. This will give you what? Terminal value. And at the end of which year, I'm using 4th year cash flow. Terminal value will be 3rd year. Then all these things I will bring it to present value. That's how I get the value of the firm. So this is a cash flow column. You will have discounting factor column, like discounting factor of year 1, discounting factor of year 2, discounting factor of year 3, and this will also be discounting factor of year 3. Last two will have same cash flow. Then you get discounted cash flow, that is you sum all these things, or that is cash flow into discounting factor, the sum of discounted cash flow, the present value is value of firm. Okay, now few questions arises. How do we estimate? Of course, practically we do in separate Excel sheets. Each of this one line will be a separate Excel sheet. We estimate so much. But from exam point of view, sales, they will tell you sales will grow by certain percentage. Sales will grow by 10%. You can calculate the sales. But how do you calculate this capex? How do you calculate this working capital? We calculate capex working capital as a percentage of sales. As a percentage of sales. For example, if current year sales is, let's say, 1 lakh, and capex current year, let's say it is 2 lakh, which means our capex, let's say not 2 lakh, let's say 50,000, which means capex is half of sales. So next year I estimate sale, half of that will be my capex. Next year I estimate sales, half of that will be my capex. And of course I'm going to take about increase in capex. I'm going to talk about purchase only. So for that ratio purpose, for this percentage purpose, that is why I'm having this base year column. This base year column is only for the purpose of arriving this ratio, not for calculating present value. For calculating present value, we take only from year 1, year 2, year 3 onwards, like that. So this is the full-fledged income statement. This is, we have done FCFF. If I subtract interest, then my answer here will be value of equity, FCFE. I'll get it. But anyway, so this is one structure, you can follow it. If they ask you value of business, we take FCFF. If they ask you value of firm, we take value of FCFF. Sometimes they'll ask you, they're planning for some new strategy. Should the new strategy be adopted? We take FCFF. Only when they ask you value of share, we come to FCFE. And you can take down this format. If you have any doubts, you can ask. After which, we'll take up problems. Hope it is done. Is it completed? Any questions? Okay, so nothing. So let me go for the question. Okay, very good.